The markets may be shaking off tariff fears, but Federal Reserve officials are concerned about their impact, maybe not just on the consumer, but elsewhere. That's according to minutes from last month's meeting. Central bankers also agreed inflation would need to drop for them to cut interest rates further. So for more on that, let's bring in Ben Emons. He is the chief market strategist over at Strategic Fortune Wealth and the FedWatch Advisors founder as well. Ben, you're the macro maven, so tell us about whether or not this consumer in America specifically is as strong as the markets and maybe retail results would dictate.
Yeah, Dom, I think if you listen or read those minutes carefully, the Fed is expressing a lot of concerns about the uncertainty. You know, it's coming out of the trade policy currently and not having really good visibility from here. So the minutes were clear about keeping themselves on hold. I want to make one note there, though. They really spent a lot of time for once on the balance sheet. It was a really different discussion from this, consumer idea. But the concept of that is to try to keep things liquid in the system, not drain the reserves too quickly. If you do, with all this uncertainty, yeah, I do think you get tightening of financial conditions, which then could impact the consumer, right? As in, you get uncertainty, you get a spill over the confidence. So I think these minutes had somewhat of a hawkish tone, I felt, but also like an emphasis on staying on hold and trying to control this inflation picture while all this uncertainty plays out about the tariffs and policy.
There isn't that much fear, though. We're looking at charts right now, Ben, of various parts of the yield curve and the Treasury complex. They're showing that prices for Treasury bonds are going higher and yields are going lower. Generally speaking, they have been for the last couple of weeks now. Do you think that's something that can be sustainable, or what other catalysts would need to happen for those rate pictures to change markedly for the Fed?
Well, I think what the yield curve is saying, Dom, is that we still have an economy that's growing faster than where potential is. We have obviously upside pressure on inflation, and we saw that last week. And although some of this PCE data may indicate a little softness, in the end, it's stickier than normal. And I think this keeps this Fed on this restrictive path. And the market has to price it into the yield curve. On the one hand, it's really still long-term rates, upward bias towards 5% in my view. And the other hand, on the front end, it's a bit about, okay, we're staying hold, so we're keeping a lot of liquidity in the system. So I think to keep it sustained, you don't want to steepen the yield curve too aggressively by projecting a picture that inflation could be out of control. So you have to keep that message quite strong here of restrictive policy. But, that could only go so long if the next inflation batch of data of inflation starts to show the actual impact of tariffs. And let's not forget, we got the tariffs on China on February 10th. That could now impact CPI the next month. So I do think there will be a sensitive number for the markets on how tariffs impact inflation from here.
Ben, it's Karen. Thanks for being on. I agree, CPI sort of trumps everything. But there was one little sort of tidbit that I thought was interesting about someone saying in the minutes that they didn't think the real rate was that far off. And I wonder if you found that, that was somewhat hawkish.
I agree, Karen. That was actually... I think it was twice said in the minutes, but yeah, they see the Fed funds rate not far away from the neutral rate. So not far away seems to suggest like there's not much room to cut here to get to neutral, which seems to be their goal, right? To get neutral, and then inflation should be at the target. So that does say that I think the actual cuts that are priced in currently are maybe still too many. Right? We have 1.5 priced in, and the Fed already thinks they're close to neutral with an inflation picture that's sticky and an economy that's strong. So I think we should pay attention to this. The Fed is still, I think, in this point of being on neutral, but there is a possibility they may go towards a tightening sort of quote-unquote bias, right, if this economy continues to show inflationary pressures.
Ben, if there is a part of the stock market right now that would be the play to make if all of those factors that you just mentioned come to fruition, this idea that we might have a reacceleration of inflation, that we might have this need to keep pace with it, what exactly then do you do? What parts of the market do you go to?
I think it was notable, Dom, on the headlines of the minutes that energy and materials and staples, they all popped higher on those headlines. Really, like the Fed acknowledging that tariffs could have an effect on inflation. I think that's the play there. And I think the market's already rotating in that direction. I think that is your play. Those sectors should outperform. And seems to be sort of this trend that we're in now where tech is lagging and those sectors are advancing. I found it notable that if you look at the Russell indices, say the Russell 1000 value index, those components of energy and materials have outperformed even more than the S&P materials and energy. So it indicates to me that the tariffs are not viewed there as a negative, but rather like the inflation is benefiting those sectors. I think that's the play to make.